Hello, everyone. Welcome to the weekly roundup. Today we'll cover monetary policy, geopolitics, and earnings releases. Hello, Ben.
Hey, Eva.
How's it going?
It's going. It's Wednesday rate announcement day, so it's exciting.
Yeah, yeah. We're going to start off with that. Between today and tomorrow, major central banks are making rate decisions. What should investors expect, especially with higher oil prices and inflation risks?
Yeah, I think that's a great place to start. I think you're right. There's a lot of things going on. So we had the Bank of Canada already. We're recording this 1 o'clock on Wednesday. So Bank of Canada was out this morning about quarter to 10 talking about what is going on. Obviously, higher inflation print. But definitely, they said for the most part that we're looking past this and we really can't forecast because it's going to have an impact. And we appreciate that it has a negative impact on consumers and the economy is not doing great. So we're not going to raise rates. And we expect not to raise rates in June as well. But couple that to your point with inflation concerns, they are certainly concerned about it. But there has been questions about drawing similarities between COVID and now, and they said, like these are very different setups than we had, which I would tend to agree with. And so as a result of that, effectively they're saying we're not panicking and raising or cutting. We're just going to hold tight and give it some time to play out a bit more because the economy is actually slowing. So it's a different setup than we saw in the COVID period, which was a shock, a demand and supply shock.
Yeah.
And I guess to your point around the other, like Federal Reserve's in about an hour, and then ECB tomorrow. Again, I think probably similar, with the exception of the FOMC later today. This is probably Powell's last meeting, and that guy is a sucker for punishment because he's lasted 8 years.
That's a long time.
It is. So I think we're going to see same from down there from the US is that they're going to not raise rates, going to look past it for now. We'll look at a couple of the slides just on the view around what could potentially happen to some of the inflationary prices. But look, I think that it is really coming into this year, as you know, we talked about, we thought that we'll probably see some deflation or disinflation. The economy continues this way because the global economy is slowing. And then we had the curveball of the attack in the Middle East. So that has really thrown things completely out of picture. The economy is continuing to slow, and it actually is going to make it slow faster because you're seeing, like you're seeing pressure on travel. You're seeing the travel numbers start to decline as well dramatically, not only because people can afford to travel, but also because the airlines and such can't afford to get jet fuel. So there, I think slowing economy, inflationary pressures is really a difficult time to be a central banker.
Yeah. So the markets continue to push higher, but the geopolitical risks haven't exactly gone away. So are investors getting too comfortable? The latest US-Iran proposal, they haven't really moved things forward. So what is happening in the markets?
That's a great question. And I think it has a lot to do with the liquidity aspect to it. I think it's interesting. There was a good interview with Paul Tudor Jones that came out, I think, yesterday, the day before, that Patrick O'Shaughnessy interviewed him for about an hour and a half. And Paul Tudor Jones, for those that don't know him, is one of the most successful hedge fund traders of our time. And really, he kind of commented on the fact that the US stock market has become a major factor for the health of their economy. And so, as the economy accelerates, as the market goes up, it has a trickle-down effect to the economy and vice versa. So, I think to your point, are people too complacent? Probably, because levels are as stretched as they've ever been. Like if you just look at the P multiple, if you look at Warren Buffett's favorite metric, it's 2, 3 times where he's comfortable investing. If you look at the amount of exposure that institutions have to liquid assets is triple what it was 5 years ago. So yeah, I think complacency is quite high, and money supply is really driving outcomes for markets. And this AI story that had disappeared 6 weeks ago has come back again to this earnings cycle. And so if you look at what's happening today, even for example, like the S&P is down, Dow's down 70 basis points, where Nasdaq is slightly in the green right now. And so you get some of those tech names doing quite well. We saw, Intel beat earnings and their stock went vertical, as you know, up 150% this year. Seagate, which is another tech company, is up today on good earnings, 25%. Micron, which has just been on a tear the last 2 years, up another 5% today. So, I think that there's a lot of shifts happening and people are getting a little bit more comfortable going back to areas that did well and selling things that like Lockheed Martin, Raytheon, like some of these military companies that you would think if the world believes the war is going to continue, that those companies would do well versus the techs. So yeah, I think we're getting comfortable that nothing bad's going to happen and uh, we'll just go back into taking some risk.
Okay. I think you picked into my notes because my next question was on earnings releases. So is there any other one you want to highlight before we see the charts?
Yeah, I think that the biggest surprises have been the tech beats. I think, as I've commented on some of the dailies, when you look ahead and we try to look for, I don't want to say diamonds in the rough, but sometimes when you're looking through earnings, you kind of look at the sectors and companies and areas that have been beat up, and maybe gave forward guidance that was weaker and their stock went down. And now we're seeing a lot of those companies that a quarter or two ago, like the Intels and Qualcomms, well, Qualcomm's going to release after the close today, so I'll be interested to watch that number, that have struggled a bit, come out when they release their new earnings, who've had some positive revisions, some good news ahead, and the stocks are popping based on those. So yeah, I think that's some of the areas that I'd be surprised with at the size of the jumps that we're seeing, really, because Intel going from I think it touched a low of maybe 20 at some point last year, up to 93, 94 today. So it's incredible to see them move. But really, yeah, it's been the techs that have surprised me to the upside.
Okay. Let's see the charts.
Just let me know if you can see that.
Yes. All
All
good.
right, perfect. Perfect. So we're recording this on, yes, Wednesday, April 29th, 1 o'clock. And so anything that happens between now and next week, we'll comment on then. Boo, boo, boo. Okay, so this chart, I think, does around what the market is interpreting as what's likely to happen from here. And it's interesting to look at it. This is the world forward curve for oil prices. And we look at this top line, which is the red line. So that's where we are today. And this bottom line, which is the black bar, is where we were February 27th, so before the invasion. And so it's been one where obviously the front end of the market has increased dramatically, where the longer end is basically saying nothing is going to happen from this point. We kind of expect a little bit higher prices a year out, a couple of quarters out, maybe, but ultimately we think we'll normalize. And so, some of that the market's interpreting that this isn't going to last forever. And some of it is just, I guess, the dynamics of energy prices. And so if you look at maybe a $10 differential between where we were in February versus where we are today, it's not dramatic. So this is what the market's thinking. Is it right? Probably not if this continues to last, because some countries were prepared, as you know, that because Canada is energy independent, it's not a giant big risk to Canada. In like Japan and China, they'd actually have about 10 months or so of oil stored. But some countries, particularly in Europe, have zero or maybe a couple of days supply of oil. So this is going to really change the potential outcomes in the different countries and places. But something I think to be conscious of, because if this chart is wrong, and we're going to see a lot of dramatic changes. So number two chart today is a world perspective on food prices. And so this is effectively the price per metric ton of urea, which is like a nitrogen fertilizer effectively. And so when we saw the spike up in the Middle East, you obviously saw you saw fertilizer prices run up. So you've seen some of those stocks move up in concert, like Archer Daniels and Nutrien, and it's kind of reflective of this. So I think this is going to be a great chart too to see, does this food price inflation continue to play through, or do we see this start to normalize back down to levels that we saw in early January, February, which more reflected a slowing economy. And so I think this will be a good chart as well to watch, to find around what is going to happen with inflation and really with the consumer. Last chart today is perspective on Canadian equity. So this is the TSX. And so this is a pretty good comparable. And even we looked at this earlier this week and thought that this was a place to just kind of review, do we get a similar period like we saw in 2021, 22, where we had this backdrop where, rates were potentially going to rise, markets started to get a bit jittery, and then we saw a pretty material drawdown 2022. 2022 was a period where every asset class, with the exception of the US dollar, went down. But this is the breakdown of the different sectors over that period of time. So energy down 23, materials 33, healthcare 64, IT 60. And so we had some pretty material drawdowns. And I'd say this sector here, energies and materials, are ones to watch right now from a perspective of, if we get a resolution, energy stocks are going to get pounded. If we don't see a resolution, probably upside in this sector. And so there's quite a bit of volatility that I think is going to come from that place, and same in materials. So just if we look at bringing forward to 2026, what we've seen so far is, since the war started, materials are down 16%. So that would be your likely your precious metals mostly, and some base metals and such. Energy's up since then a little bit. Industrials are down but up since the war, and these are the biggest drawdowns. So you've seen IT was down kind of 32%, kind of max drawdown. So we've seen that snap back. So that would be the Shopify, Celesticas of the world. We've seen those down hard and snap back up. So, potentially if we enter that period, which was 2022, which was that stagflationary environment, rates rising, economy slowing, this is a really interesting side by side to say there's still some risk, and to Eva's point earlier, some complacency. And last one, just before we wrap up and talk about what's going on next week. So financial market overview. So performance of major asset classes since February 27th, when the war started. And so WTI, which is which is the price of oil in the world, up 41% since then. So again, this is priced off of 1 month futures. So that's been a huge uptick. And on the previous chart, you would have seen that. Commodities, so up 22%. So yeah, commodities again, this is pressuring that inflation narrative that everybody's worried about. S&P actually showing positive now, 4.3%. MSCI, which is the Asia Pac, which is the East, and MSCI Emerging, which is emerging markets, which is the total emerging markets. Cash is flat. TS actually down through this period. Bonds a little bit down. And gold is probably the one that's taken it the most on the chin, which is down about 10%. People ask me, why is that the case? We're in a period of traumatic environment where the world's concerned about this, that, or the other thing. There's a number of reasons why gold would be down. Some of it was bought into the conflict, so as a place to park some of your capital with a worry that something bad could potentially happen in the world, and that's what happens. The stock went the commodity price ran up, so you see some profit taking. Additionally, when you're having a risk off environment, the markets are leveraged and people typically are going to sell things that work for them. And so as they reduce risk and reduce leverage in portfolios, they'd be taking some winners off the table. Gold would be the biggest winner over this recent period. And so you would have seen some profit taking appear there. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. Everyone's risk tolerance is unique and independent. If you have any questions for Eva or I about your risk tolerance, about anything we talked about today, please feel free to reach out.
Yeah. Thank you, Ben.
Hmm?
So what are we looking at for next week?
So I think there is still lots of earnings to come in Canada, so we'll be watching that. Obviously, we are month end tomorrow, so May 1st on Friday, so we're heading into a new month. Equity markets did quite well in April. And so we saw quite a big bounce in a number of areas and sectors. And so, we launched the basket last year and we saw a pretty good jump this month, up about 5%. So be reviewing positions as we come into month end. We make some changes and adjustments. I would say that would be the two biggest drivers. The third one, of course, is let's continue to follow the conflict. And to your point, can we get closer to a resolution or not? Because that's going to have an impact. And like the Bank of Canada said today, I'm sure the Fed will say, I'm sure the ECB will say that the longer the conflict lasts, the worse this is going to be for the global economy. And so that is overhang until it passes.
Okay, perfect. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and enjoy the rest of your day. Bye.
Thanks. See you.